Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. So the results are in and very much in line with pundits' predictions. Labour will be forming the next government. Now, Need to Know has no aspirations to be a political podcast. So joining me to look at Thursday night's result from a market perspective, a multi-asset strategist, David Broomfield, and making a very welcome return to Need to Know, Coutts CIO, Fahad Kamal. Fahad, I'd like to start with you first. We know the old, the saying that markets hate uncertainty. Well, we certainly got a clear result. I mean, it's early. We're recording this very early on Friday morning, but we have got a clear result. So what do we think markets will make of this in the short term?
Well, Sarah, we'd have the benefit of knowing because I'm staring at the Bloomberg screens right now. And to be honest, if you didn't know there was an election this morning, you wouldn't have known that there was by just the market movement. Sterling is up slightly, but nothing that is out of the ordinary trading day. And the futures for the UK equity index are also up, but also weekly, so and nothing that would be unusual on any other day either. But I would think that in itself tells a story. There was very, very broad consensus on what the outcome is likely to be. That consensus has come to pass almost exactly as predicted, and the markets had largely priced in this outcome. Therefore, no big movement. Everything was as expected.
Well, so the news, as expected, has proved to be a good thing for markets. They're taking it in their stride. So that's the immediate reaction. David, but obviously we from an investment house don't look at things from a day-to-day basis. We think long-term. And I know that the team have done some research on the impact of elections on investment returns, looking over a much longer period of time. Now, this is the first Labour government in, I think it's 14 years, and we're not going to make a political judgment, but is there any evidence to suggest there's a difference in the way markets perform over the longer term under different governments?
Thanks, Sarah. Hi, everybody. UK equity performance under different governments over the last 70 years shows quite a resounding conclusion that it doesn't really matter who is in power. The market tends to, in the long term, just focus on what is important, which is economics, earnings growth, and profitability. So you're quite right. The team here at Coutts looked at data back starting at the 1955 Churchill election, and you can see that the average returns under both Conservative and Labour governments are broadly the same. So it's around 4.1% and 4.8% respectively. And that's what history tells us. And, we know with some certainty, and we look at this picture, this is a global phenomenon, that what drives markets is earnings growth. And earnings growth is all about GDP growth. So I suppose the question then is really, well, what does the Labour government mean for economic growth? And, the history is really clear. But if you look at what has been stated pretty publicly by Labour, they plan to follow the current Conservative government's targeting a reduction in debt to GDP over 5 years. That's all proved by the OBR. So that's, again, just going through that will be proved by the OBR. That's going through the system. And we know, there's limited scope for additional borrowing. And I think what's in everyone's mind, in both public policy circles and markets, is not to have a repeat of the 2022 mini budget. Yeah. So, this is very, as Fahad said, this is well priced in, well signposted, and just going through the standard checks and balances that we would expect for any incoming government. So, back to this point of what drives earnings growth, economic growth, what the investment bank research shows out there in the city is that the spending plans that have been announced are modestly positive for growth, modestly positive for inflation. So I think this year, it's not going to be politics that drives markets. It never is. What will drive us this year are things like the rate cutting cycle and earnings growth. That's what's going to drive markets.
Okay. So we're saying then, obviously the result was as expected. It hasn't really largely impacted markets. The research tells us historically that whoever is in power doesn't really materially impact returns. But you wanted to add something, David.
Well, I think let me just illustrate it with a data point. So if you go back to the beginning of June, you can see how the gilt market changed, right? You saw the yield curve was inverted, and then it de-inverted or disinverted. And again, these are modest moves. These aren't radical moves, but this is just the market pricing in a new spending program and a very modest increase in demand and therefore inflationary expectations. So the point here is that markets already priced these things in. By Friday morning after the election, it's in the price.
Fahad, I'll come to you in a moment. But David, for those that don't understand, can you just explain what you mean by an inverted yield curve?
Yeah, so the yield curve just traces the future pathway of inflation expectations, or interest rates really, and inflation expectations. So if people expect inflation to increase in the future and therefore interest rates to go up, you'd expect a yield curve that's positively sloped. And then obviously the reverse is true. If people expect inflation to fall in the future and interest rates to fall, you would expect the yield curve to invert. As I said, these are modest moves. These aren't radical moves in the yield curve. It just shows you the market very subtly just pricing in the different outcomes. And that was priced in at the beginning of June.
Okay, all right. So Fahad, you wanted to say something?
Just quickly touching on 2 points that David mentioned. One, he used the phrase checks and balances, and that really is a key phrase. That is really, at the end of the day, the reason why there has been no huge difference between Labour administrations and Tory administrations for the last 70-odd years. There are inherent checks and balances in our political system. We have a country where we are blessed with deep institutional strength. Courts, the judiciary, functioning markets, rule of law, etc. Lots and lots of things. That is ultimately the reason why we are entirely apolitical, because it tends not to matter from an investing perspective. We live in a stable country where we have a predictable pathway of rules, regulations, etc. And that we focus on what does matter, which is the earnings profile and the wider economy, as David said. That's sort of point one. And second point was that I would say that if there is sort of one lesson that has been learned, of recently, which is going to have a policy implication, and this is not just in the UK, but this really resonated far beyond our borders, was the mini budget that David mentioned. That does very strongly lead us or incentivize new policymakers to know what the parameters and the bounds are of what can be done, right? Yeah. There is something to be said for thinking out of the box, but the bond market and markets in general have to be taken on board and have to be thought of as well. You can't magic up solutions that the market isn't ready for, and I think that was quite a seminal moment. Not just, as I said, for us, but for policymakers all around the world, that they have to be very cognizant about having policies that are sound, tested, and pragmatic, and one that the markets would accept.
Okay, all right then. Well, then that brings me to the final point, and this is for both of you. But perhaps let's start with you, Fahad. I mean, obviously, we've got this clear result. Markets seem to be calm in the response because it was very much as expected. We know what history tells us. That doesn't mean it's going to happen in the future, but history certainly tells us that the markets don't react vastly differently depending on who's in power. But does the result change the way we approach investing?
No, simply no. It doesn't. We have as I've mentioned quite a few times already, we have an investing process that effectively takes into account two key factors. One is where are we getting the best premium on various asset classes, number one, and two, where are we in the economic cycle? Simply put, those are the things that drive our investment process.
Yeah. Thank you, Fahad. David, last words from you.
Well, I think Fahad's exactly right. Remember my point. It's all about earnings growth. It's all about wherever that earnings growth is, you can be agnostic. Regionally, sectorally. Our team, as far as the business cycle is concerned, is focused on where you're seeing that growth. So, these events politically are extremely important to every country where they're happening. But it's really important, I think, to just have that broader view of pursuing growth wherever it may be.
Yeah, thank you very much. Thank you very much, both of you, for your insights. It's been really interesting to catch up with you, and I appreciate you getting up so early in the morning after a full night of listening into results to give us your thoughts. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you for listening. And for more analysis on last night's result and what it might mean for investors, make sure you go to Coutts.com. You'll find articles up there, and you'll find obviously the Need to Know page on Coutts.com as well. We'll be back next week with more Need to Know. Until then, bye for now.